Rukshad Saraf, Managing Director, Investment Manager, India Specialist with Pacific Group. He represents JP Morgan Asset Management. Rukshad, good morning. What a delight to have you back on ET now. Rukshad, how do you connect the growth slowdown in India to the valuations for the market and the returns the market has given in 2012? And do you think that India has priced in all the reforms push?
I think firstly it's important to recognize that while growth has slowed down considerably, it's consensus. It is no longer a negative surprise that growth is at 5.5%. And therefore, I think we saw in 2012 the market largely ignore growth-related concerns and in fact deliver a 26% return. Now we're in the stage where we are anticipating a recovery, and that is being aided by the more recent reform initiatives by the government. Whether it's priced in or not is a function of two things. One, whether they are actually implemented rather than merely announced, and second, whether they will continue with increased reform momentum.
Right. The important question is, Rukshad, in terms of returns, how much better can we do from here? I mean, do you expect 2013 to be more like 2012 with, 25% plus returns, or like 2011 in terms of the kind of slam dunk the market witnessed? When you speak to investors, is there a sense of optimism or caution?
No, 2011 was very different from 2012. In fact, 2012 benefited, I think, from a lot of the negativity that 2011 priced in. I expect that the year will be much more like 2012 than 11. So there'll be, I expect there'll be positive returns rather than a 30% correction as we saw in 11.
Rukshad, so what is the biggest risk for India, political risk or macro risk? And also, has the risk of a downgrade now receded?
Well, I don't think the risk has gone away. But I read an article recently where members of or employees of S&P were quoted saying that the risk has modestly reduced. I think that the new finance minister over the last 4 or 5 months, and backed by the central government, has certainly taken a number of steps, some of them quite bold steps, to tackle deficit, to tackle growth-related issues. And, this is not an easy time from a macroeconomic standpoint, yet the government has taken these steps. So the risk remains, and is not insignificant, but I think at the margin it has diminished. And if you look at other risks overall, yes, of course, politics tends to be a risk, and elections would pose certainly an element of volatility. But you look back at the elections over the last, 20 years that I've been doing this, the first thing I'd say is it's very difficult to predict the outcome of elections. The last 2 elections showed that the consensus opinion can be very wrong. I was wrong myself on both counts, number one. Number two, how you interpret the outcome of the elections can also be very, very difficult at the inception. So this government, has certainly proven to be quite different from the expectation 4 years ago, as was the case before that. So, and again, when there's volatility that relates to elections and politics, if you're courageous enough and disciplined enough, history shows that you could make reasonably good returns, if not slightly abnormal returns, buying into those big corrections if and when they manifest. So I'd be reasonably confident of this year.
Rukshad, what has been your portfolio strategy for India post the 2012 rally? Have you been buying, allocating more capital, or reducing your net positions in your India fund?
I think it's fair to say that we at JP Morgan Asset Management, we've historically had a very supportive and constructive view on India, at least for the 10 years that I've been here. And on occasion, for tactical reasons, we may have been neutral. But at the margin, I think our inclination is to increase allocation to India on an opportunistic basis.
So, Rukshad, but what is your overall view on the markets? How are you positioning yourself right now?
Well, the funds that I run are India dedicated. So they generally tend to be fully invested or largely fully invested. And that's, the sort of normal position of the portfolio. Within that, our own portfolios in the offshore side at JP Morgan Asset Management don't tend to churn and trade very much. So the portfolios remain relatively unchanged. We still like, and our portfolio strategy is very, very bottom up. obviously cognizant about the top-down macro view, but every decision is largely an individual stock level decision. So most of our investments have been there for the long time. We find a number of attractive businesses in the financial services space. These are businesses which compound at 15, 20, in some cases 30% per annum over long periods. We find that to be true in the large cap and in the smaller cap space. There are a number of attractive businesses within consumption. So even though the economy has slowed, some pockets of consumption have remained relatively resilient and likely to remain so, if not gather momentum as rates come down and economic growth recovers. So I think there's enough opportunity for a portfolio manager to create a portfolio of 30 or 40 attractive stocks, almost not getting too concerned by the macro.
Rukshad, come in on the themes that you're big on in India at this point in your fund.
I think we still remain invested. We are overweight in the financial services space. We still remain overweight cement, which is proving to be an attractive opportunity because some of these stocks have corrected recently. I think within consumption also we're seeing some attractive opportunities. As you know, I'm not willing to name individual stocks, but I think within those sectors, and even to some extent within the domestic cyclicals, there's a fair bit of value available for the more patient investor.
Rukshad, so finally, after 25% plus returns in 2012, what are your return expectations from Indian markets going forward?
And again, predicting specific stock market returns in a specific time frame is very difficult. But let me give you a context that will help at least partly answer this question. I think, if you break it down into three sources, earnings, valuations, and again, from our standpoint, currency, I'll try and, look at that individually. So, the expectation on earnings is that growth in the next fiscal year will be, let's say, about mid-teens, 14, 15%. I think that's a broadly reasonable estimate at this point. So that's a positive backdrop, which will mean that earnings are accelerating over fiscal 13's single-digit number of 7-8%. So that's positive. Valuations at the moment are middling, right in the middle of the long-term average, and therefore let's assume that they contribute nothing to the change in returns. But returns are driven by earnings. So 14 or 15% driven by earnings is easily not easily, but it's understandable to expect that. And then from our standpoint, we think that the currency is at the moment anywhere between 2 to 5% undervalued. If the fundamentals of the currency start to improve, which means if there's any easing up in the current account deficit, dollar returns could be higher. So, some sort of mid to high teens is a reasonable expectations. And valuations will change based on flows, domestic as well as foreign flows. Obviously, this will all be punctuated, as you said, by elections. But again, I think that's a source of volatility rather than a disruption of the Indian investment case.